In 2009, a teacher in Ohio did something most financial advisors would have called reckless. While her colleagues were pulling their retirement accounts out of the market, she kept buying. Every month, the same amount, the same funds, no matter how bad the headlines got. By 2013, her portfolio had not just recovered, it had nearly doubled from its pre-crash value. What did she know that everyone else didn't? Most people treat a market crash like a natural disaster, something that arrives without warning, destroys everything in its path, and leaves you rebuilding from zero. That's the consensus. But the data tells a different story. Every major crash in the last 100 years has followed a recognizable pattern, and the people who understood that pattern didn't just survive, they came out ahead. So here's the question worth sitting with. If crashes are this predictable, why do the majority of investors still end up on the wrong side of them? That gap between knowing crashes happen and actually being prepared when one hits is what this video is about. Because if you don't understand how to position yourself before the market turns, you won't make the right call when it matters. You'll feel the pressure and you'll sell. My name is Alex, and if you've ever watched your portfolio drop and felt that pull to just get out, stay with me, because that instinct is costing you more than you think. I'm going to show you exactly why panic is the most expensive financial decision you can make, and the 3-step system that removes emotion from the equation entirely. Once you understand how compounding actually behaves under pressure, you'll stop fearing crashes and start seeing them differently. It starts with a piece of math almost nobody talks about, and it goes by the name asymmetry of losses. Nobody warns you about the math on the way down. That's the part that catches people off guard. Not the crash itself, but what the numbers actually require from you afterward. And once you see it clearly, the way most people respond to a market downturn stops making sense entirely. Here's the concept at the center of it. It's called the asymmetry of losses, and it is one of the most counterintuitive ideas in all of personal finance. The basic premise is this: losing money and making money are not mirror images of each other. They don't cancel out evenly. The math is fundamentally lopsided, and it is not lopsided in your favor. Let me walk you through it with a concrete example. Say you invest $10,000. The market does what it usually does, moves up, pulls back, moves up again. And after 2 years of steady 10% annual gains, your account sits at $12,100. Not life-changing, but compounding is doing its job. You're ahead. Things feel good. Then the market drops 40%. Your account doesn't just give back your gains, it falls all the way to $7,260. You've lost nearly $5,000 from your high point. More than that, you've lost almost 28% of your original $10,000. You didn't just stop moving forward, you went backward. And here is where the trap closes. To get back to $12,100 from $7,260, you don't need a 40% gain, you need 67%. A 40% loss requires a 67% gain just to break even. And that is the asymmetry. The hole is always deeper than it looks, and climbing out takes far longer than falling in ever did. Now apply that to someone's actual life, not a textbook example. Marcus is a 38-year-old project manager in Denver. He's been contributing to his brokerage account for 6 years, investing consistently, doing everything right. By early 2025, his portfolio had grown to $114,000. Then the market sells off hard, down 38% over 7 months. His account drops to just under $71,000. He's not panicking yet. He tells himself he'll ride it out, but then he gets passed over for a promotion. His car needs $4,000 in repairs. The portfolio is still sitting at $71,000, and every time he opens the app, the number feels like a verdict. And so in November, he sells. He moves everything to cash. What Marcus didn't calculate, what almost nobody calculates in that moment, is that to get from $71,000 back to $114,000, he needed a 61% gain, not just from the market, from whatever he reinvested in, at whatever point he decided to get back in, which, for most people in his position, is after the recovery has already begun. After the best days have passed, that's the double cost of selling at the bottom. You lock in the loss, and you almost guarantee you'll miss the rebound. Here's what makes this especially hard to absorb. A 40% drop doesn't feel like a mathematical trap while it's happening. It feels like a rational response to an irrational situation. The market is falling. Everyone around you is scared. Selling feels like the responsible thing to do, like you're protecting what's left. That instinct is not stupidity. It's wiring. but it is expensive wiring, and it costs the average retail investor somewhere between 1 and 2% in annual returns every year, according to research from Morningstar, just from poorly timed decisions. Which brings up an obvious question. If crashes are this damaging, and the emotional response is this predictable, is there any way to actually see them coming? Not perfectly, but better than most people think. Because when you look at the historical record, market crashes are not random events scattered unpredictably across time. They follow a rhythm, and understanding that rhythm is the first step toward not being caught off guard when the next one arrives, which is exactly what the data on predictable crashes shows. There's a version of market crashes that lives in the cultural imagination. Sudden, unpredictable, once-in-a-generation events that blindside everyone without warning. That version makes for good headlines. It also happens to be wrong. Pull back far enough, and what looks like chaos starts to look like clockwork. The historical record on U.S. market downturns is more consistent than most people realize, and more useful. A correction, defined as a drop of 10% or more from a recent peak, happens roughly once every 12 to 16 months. Not occasionally, not in bad decades. On average, every single year. A bear market, which is a decline of 20% or more, shows up every 4 to 5 years. And a serious crash, the kind that drops 30% or deeper and reshapes how an entire generation thinks about investing, happens several times across a typical investing career. Read that again. Several times in your career. Not once. Not if you're unlucky. This is not a pessimistic view of markets. Markets have recovered from every single one of those crashes. Every correction, every bear market, every collapse. The S&P 500 has averaged roughly 10% annually over the long run, crashes included. The point isn't that downturns are dangerous. The point is that treating them as surprises is a choice, and it's an expensive one. Think about what it actually means to be surprised by something that happens every 12 months. A correction is essentially an annual event. If you've been invested for 5 years and haven't lived through at least one, you've been unusually lucky, and that luck almost certainly ends. Being surprised by a correction in your portfolio is a little like being surprised by winter. It arrives on a slightly different schedule each year, and some winters are harsher than others, but nobody who's been paying attention treats it as a shock. The deeper problem isn't that people don't know crashes happen. Most investors, if you asked them directly, would tell you yes, markets go down sometimes. Of course they do. The problem is the gap between knowing something intellectually and being emotionally prepared when it arrives. That gap is where most of the damage happens. Here's a useful frame. Imagine two investors, both 34 years old, both putting away $500 a month into a diversified index fund. The first one, Diane, a graphic designer in Austin, has read about market cycles. She knows corrections are normal. When her portfolio drops 12% in the spring of 2025, she feels uneasy, but she's not shocked. She keeps her automatic contributions running. She doesn't change anything. By the following January, her portfolio had recovered and moved higher. The second investor, Tom, a sales manager in Charlotte, also knew, in the abstract, that markets go down. But when his account dropped 12%, it felt different from what he expected. It felt like something had gone wrong. He paused his contributions. He started watching the market daily. He sold half his position when it dropped another 4%, just to stop the bleeding. Same market, same timeline. Two completely different outcomes. Not because of what the market did, but because of how each person had prepared, mentally and structurally, before the drop arrived. That preparation is everything. And it starts with accepting one simple idea. The next crash is not a possibility. It is a scheduled event on an uncertain date. Your job is not to predict it. Your job is to be ready before it shows up. So what does ready actually look like? Not a feeling, not a vague intention to stay calm. A concrete, pre-built system that keeps you from making the wrong decision when every instinct you have is pushing you toward it. Because when things get bad, willpower is not enough. Discipline under pressure is not something most people conjure in the moment. It has to be built in advance. That is exactly what the 3-step plan is designed to do. Give you a structure that holds even when your judgment is compromised by fear. And the first pillar of that plan is something most people think they have, but almost nobody actually builds correctly. Most people think preparation means having the right information. It doesn't. Information without structure collapses the moment things get emotional. And in a market crash, things always get emotional. What actually protects you is a system, something built before the pressure arrives, so it keeps running even when your judgment is compromised. The three-step plan breaks that system down into its most essential components, and each one does a specific job that the others can't cover. The first step is the one most people skip, undersize, or raid for the wrong reasons. The emergency fund. 3 to 6 months of living expenses, sitting in cash, in a high-yield savings account. As of early 2026, the best high-yield savings accounts are still offering rates between 4 and 4.5%, meaningfully above zero, which is what most checking accounts pay. That matters, but it's not the main point. The main point is what this fund actually does during a downturn. Bad things tend to arrive together. Job losses cluster around recessions. Unexpected expenses don't pause because the market is down. Without a cash buffer, a medical bill, or a sudden income disruption doesn't just create financial stress. It creates forced selling. You liquidate investments not because you want to, but because you have no other option. You sell at the worst possible time, at the worst possible prices, and the asymmetry of losses does the rest. The emergency fund is not a savings goal. It is the structural wall that keeps a personal crisis from becoming a portfolio crisis. Think of it as the foundation everything else rests on. Without it, the next two steps are built on sand. Step 2 is dollar cost averaging, which sounds technical and isn't. The concept is straightforward. You invest a fixed amount on a fixed schedule, regardless of what the market is doing. $200 a month, $500 a month. Whatever the number is, it goes in automatically, every month, whether the market is up 3% or down 15%. Here's why this works. When prices are high, your fixed contribution buys fewer shares. When prices drop, the same contribution buys more. A $300 monthly investment buys 6 shares at $50 each. The same $300 buys 15 shares when the price falls to 20. You are, by design, accumulating more of the asset when it's on sale, without having to make a single active decision in the moment. Consider Rachel, a 31-year-old nurse in Phoenix. She set up automatic contributions to her index fund in 2023 and never changed the amount. Through the volatility of 2024 and into the correction of early 2025, she kept buying. She didn't increase her contributions during the dip because she felt brave. She just didn't stop, because the automation removed the decision entirely. By mid-2025, her average cost per share was lower than it would have been if she'd only invested during the calm periods. The crash, in a mechanical sense, had worked in her favor. That's the underrated power of automation. It doesn't require courage, it just requires setup. Step 3 is diversification, and not the version most people think they have. Owning 10 different technology stocks is not diversification. It is a concentration with extra steps. Real diversification means owning assets that don't all move in the same direction at the same time. U.S. equities alongside international stocks. Bonds alongside real estate investment trusts. Asset classes that respond differently to the same economic conditions. When U.S. growth stocks sold off sharply in early 2025, investment-grade bonds and certain international markets held relatively steady. Investors with genuine diversification didn't escape the turbulence, but they absorbed it. Their portfolios dropped less, recovered faster, and crucially, gave them less psychological reason to panic. That last part matters more than people admit. A portfolio that drops 22% feels very different from one that drops 38%, even if both eventually recover fully. The shallower the drop, the easier it is to stay in. And in staying in is almost always the right call, which is where the plan starts to meet its real test. Because you can build all 3 of these pillars correctly and still blow it, not because the system failed, but because of something that has nothing to do with spreadsheets or savings rates. It has to do with how your brain processes loss. And that mechanism, loss aversion, is the reason even well-prepared investors sometimes make the worst possible decision at exactly the wrong moment. You can do everything right and still lose. Not because your strategy was wrong, not because the market surprised you, but because at the critical moment, the moment the plan actually needed to run, you overrode it. You made a decision that felt completely rational, maybe even responsible, and it cost you years of compounding in a single afternoon. That is not a character flaw. It is a design flaw. And understanding why it happens is the only way to build a defense against it. The mechanism is called loss aversion, and it is one of the most well-documented findings in behavioral economics. The core idea is simple. Losses and gains are not processed equally by the human brain. Psychologically, losing $1,000 feels roughly twice as painful as gaining $1,000 feels good. The math is symmetrical. The emotional experience is not. This is not a modern problem. It is an ancient one. For most of human history, losses were genuinely more dangerous than equivalent gains. Missing a meal was more threatening than finding an extra one. The brain that treated losses as urgent emergencies survived longer than the brain that didn't. That wiring is still running in the background every time you open your brokerage account during a downturn. The problem is that the same instinct that kept your ancestors alive is actively working against your retirement account. When a portfolio drops 20 or 30%, the brain doesn't register it as a temporary fluctuation in a long-term growth vehicle. It registers it as a threat, a 5-alarm signal. And the response it generates, sell, get out, stop the bleeding, feels not just reasonable, but necessary, like the adult thing to do. Here's where it gets costly. That response tends to arrive at exactly the wrong moment. James is a 42-year-old civil engineer in Atlanta. He had been investing steadily for 9 years. His portfolio, built on low-cost index funds with a solid bond allocation, had grown to $230,000 by late 2024. When the market pulled back sharply in the first quarter of 2025, his account dropped to around $162,000. On paper, he knew this was temporary. He had read enough to understand market cycles. He told himself he would hold. Then the drop extended another 8% over 6 weeks. His account was now at $149,000. He started checking it daily, then twice daily, and each refresh felt like a small emergency. His wife asked if they should do something. He moved 40% of his portfolio to a money market fund in March, just to stabilize things. The market bottomed shortly after. By September 2025, it had recovered fully. James was partially in cash for most of that recovery. He caught some of it, but not all. The cost of those 2 months of fear, by his own rough calculation, was somewhere between $18,000 and $22,000 in missed gains. He didn't make a stupid decision. He made a very human one. And the system he had built wasn't designed to stop him from making it. This is exactly what Peter Lynch was describing when he said that many investors in his fund, a fund that returned 29% annually over 13 years, still managed to lose money. They got in after strong runs, bailed during pullbacks, and missed the recoveries. The fund performed. The investors didn't. The gap between those two things is almost entirely explained by loss aversion. The fix is not willpower. Willpower is unreliable under pressure, and pressure is precisely when you need the fix to work. The actual solution is a written investment plan, a document you create when you are calm, specific about your targets, your timeline, and your rules for what you will and won't do during a downturn. Something you can return to when the instinct to act becomes overwhelming. Something that makes inaction feel like a decision rather than a failure. Because when the data is in front of you, when you can see in black and white what panic selling actually costs, the case for staying put becomes a lot harder to argue with. And that data is more convincing than most people expect. Here is a number that should make you deeply uncomfortable. Missing just 5 trading days can quietly destroy decades of patient investing. Not 5 years, not 5 months, 5 days. Out of the roughly 2,500 trading days in a typical decade, missing 5 of the right ones, the best ones, cuts your long-term return by almost 40%. That is not a rounding error. That is the difference between a retirement that works, that requires you to keep working. The data on this comes from a long-running analysis of S&P 500 returns. An investor who stayed fully invested over a recent 20-year period, ending in 2025, turned an initial investment of $100,000 into approximately $720,000. The same investor, same starting amount, and same 20 years, but who missed the 10 best trading days, ended up with roughly $330,000, less than half, for 10 days of being out of the market. Let that sit for a moment. You didn't make bad picks. You didn't invest in fraudulent companies. You didn't ignore diversification or skip your contributions. You just weren't there on 10 specific days out of 7,000, and it cost you nearly $400,000. Now here's the part that makes this even harder to work around. Those best days, the explosive recovery sessions that do so much of the heavy lifting in a long-term portfolio, tend to cluster immediately after the worst days. The market drops hard for several sessions. Fear peaks. Selling accelerates. And then, without warning, it snaps back, sometimes violently. A 3 or 4% single day gain that reverses a week of losses. And if you sold during the panic, you missed it entirely. This is not a coincidence. It is a structural feature of how markets process uncertainty. The volatility that creates the worst days is the same volatility that generates the best ones. You cannot reliably have one without the other, which means that trying to sidestep the pain almost always means sidestepping the gain as well. Consider two colleagues at the same company, both 50 years old, both with $200,000 in their retirement accounts at the start of 2020. Nina, a senior accountant in Boston, had a written investment plan she had built with her financial advisor 2 years earlier. When markets dropped nearly 34% in February and March of 2020, she felt the fear. She read the same headlines everyone else read, but her plan had a specific rule: no reallocation during a drawdown of less than 40%. She stayed put. By the end of 2020, her account had recovered and reached $264,000. Her colleague, Greg, a logistics coordinator at the same firm, moved to cash in late March 2020 near the bottom. He waited until he felt more confident before reinvesting, which turned out to be late July. He missed the sharpest part of the recovery. By the end of 2020, his account sat at around $211,000. Same starting point, same employer, same market, a $53,000 gap, created entirely by 11 weeks of being on the sideline. By 2025, assuming similar contribution patterns in market performance, that gap had compounded into something closer to $80,000. One decision, made in a moment of completely understandable fear, with a multi-decade tail. This is why the written plan matters so much, not as a motivational document, not as a statement of good intentions, but as a pre-commitment device, something that makes the decision before the emotional pressure arrives, so you don't have to make it again in the middle of a crisis. The evidence is not subtle. Investors who stayed fully invested through the volatility of 2022, correction of early 2025, and every downturn in between consistently outperformed those who moved to safety and waited for clarity. Clarity in markets tends to arrive after the opportunity has already passed, which brings everything in this video to a single, quiet conclusion, not a rallying cry, not a list of action items, just the one realization that changes how you see every market downturn from this point forward, and what it actually means for the investor who is ready for it. Here's what this all comes down to. Crashes are not anomalies. They are scheduled events on uncertain dates. The investors who come out ahead are not smarter or luckier. They are simply more prepared. They built the system before the pressure arrived, and then they let it run. A few things worth holding on to. The asymmetry of losses means the hole is always deeper than it looks, which is exactly why not falling in matters more than climbing out. An emergency fund is not a savings target. It is a structural firewall. Automation removes the decision at the moment your judgment is most compromised, and missing just 10 good days in the market can quietly cut your long-term wealth in half. Watch for the moment the news feels unbearable, and every instinct says to act. That moment is usually the one that separates the two groups. There is a related question this video doesn't answer, and it might be the more important one. If staying invested is the right move during a crash, how do you know when your actual portfolio is built to survive one? That is worth thinking about before the next downturn arrives. If this changed how you see it, share it with someone who needs to hear it before the next one hits.